Hey guys, and welcome back to the channel. Tonight, we're not talking about emperors or epic battles, but something just as powerful, something that built empires and brought them crashing down. Ancient banking. Yes, long before Wall Street, cryptocurrency, or even that little chip in your card. Our ancestors were already masters of money, debt, and surprisingly sophisticated finance. So, before we dive into the clay tablets and silver shekels of the past, take a moment to like this video and subscribe, but only if you genuinely enjoy these deep dives into the unexpected corners of history. And, as always, let me know in the comments where you're tuning in from and what time it is for you. It's always fascinating to see our global community joining us. Now, dim those lights, maybe turn on a fan for that soft background hum, and let's ease into tonight's surprisingly modern journey into ancient finance. Long before Wall Street, before vaults and banknotes and savings accounts, banking began in the mud-brick cities of ancient Mesopotamia, the cradle of civilization. And surprisingly, the first bankers weren't suited financiers. They were priests. In cities like Uruk, Lagash, and later Babylon, temples weren't just religious centers. They were the administrative and economic hearts of urban life. These towering ziggurats and their surrounding complexes acted as both spiritual sanctuaries and financial hubs. Farmers and merchants didn't just come to pray. They came to deposit grain, receive loans, and settle debts. Why temples? Because they were the most stable, trusted institutions. The gods didn't run off with your money, and the priesthood had an army of scribes to keep meticulous records. When a farmer delivered a portion of his harvest to the temple granary, he'd receive a clay tablet with a cuneiform inscription, the quantity stored, the date, the depositor's name, and sometimes a witness. This wasn't just a receipt, it was an early form of a check. These receipts could then be transferred. A farmer in debt could hand over his tablet to a creditor as repayment. A merchant could use them to buy goods or settle accounts. In this way, the clay tablet became the ancestor of promissory notes, deposit slips, and IOUs. Temples also issued loans not just in grain, but in silver, sheep, and other commodities. Interest rates were high by modern standards, typically around 20% for grain and 33% for silver. These weren't casual transactions either. Defaulting on a temple loan could lead to the loss of land, property, or even personal freedom. Interestingly, the concept of compound interest was understood and feared. Some legal codes, like those of Hammurabi, tried to limit or regulate interest practices. Others formalized debt slavery as a punishment. This was banking in its rawest, most primal form, both brilliant and brutal. So while modern banks might be glass towers and spreadsheets, their bones are ancient. The earliest financial systems weren't born in markets. They were born in temples. And in Mesopotamia, the gods didn't just judge your soul. They also balanced your books. By the time Babylon rose to power under kings like Hammurabi in the 18th century BCE, Mesopotamian banking had become more sophisticated and more personal. While temples and palaces remained important economic players, a new class of financial professionals began to emerge. Private money lenders. These early financiers weren't working out of marble lobbies. They conducted business in humble homes, market stalls, or even beside temple courtyards. But they had one thing temples didn't: flexibility. Where temple loans were often seasonal and tied to agricultural cycles, private money lenders could tailor deals for merchants, traders, and craftsmen, offering loans in silver, Babylon's preferred unit of currency. Silver wasn't minted into coins yet. That innovation would come much later. Instead, it was weighed out by the shekel, and loans were documented on clay tablets. These tablets detailed the borrower, lender, amount lent, interest rate, repayment date, and sometimes even collateral. If a debtor defaulted, Lenders could legally seize land, goods, or even family members. Some contracts read more like threats than agreements. One fascinating innovation was the rise of joint liability loans, where two or more individuals shared responsibility for repayment. This helped reduce the lender's risk and planted the seeds for what we now call co-signed loans. Debt was everywhere in Babylonian society. Farmers borrowed to plant crops, merchants borrowed to finance caravan expeditions, and builders took loans for large construction projects. Debt slavery was a real risk, but the law eventually began to push back. Hammurabi's famous code offered some relief. For example, if a storm destroyed your crops, you might be exempted from interest that season. Babylon also introduced promissory notes and letters of credit, used to transfer money across distances without transporting physical silver. These tools allowed wealthy merchants to expand, trade, and move money without the risk of robbery, a protoform of the modern banking network. It's easy to think of banking as a modern system tied to stock tickers and interest rates. But in Babylon, the same mechanics, lending, collateral, interest, and risk, were already shaping lives and livelihoods. Their tools were made of clay, not code, but the game was much the same. Pretty incredible, right? Who knew clay tablets could be so powerful? Let me know what surprises you most about Babylonian finance. All right, if you're finding this ancient economic history as fascinating as I do, please give this video a like. It really helps more people discover these connections to our modern world. And if you haven't subscribed yet, now's your chance. In ancient Egypt, economic life revolved around two constants, the Nile River and the pharaoh's granaries. While Egypt didn't develop a formal banking system in the same way as Mesopotamia or later Greece, it nonetheless maintained sophisticated financial practices rooted in temples, royal treasuries, and massive state-administered storage systems. Instead of coins or silver shekels, Egypt's economy was built on grain. Wheat and barley weren't just food, they were currency. Taxes, wages, and debts were often measured in sacks of grain, and these were stored in vast, centralized granaries. Like Babylonian temples, Egyptian temples functioned as both religious and economic centers, serving as secure storage sites and financial record offices. Scribes recorded every delivery, withdrawal, and transaction on ostraca pottery shards or papyrus scrolls. These acted as receipts, contracts, and even early forms of checks. If you deposited 10 sacks of grain at the temple granary in Thebes, you might receive a receipt which could be traded or presented elsewhere to retrieve an equivalent amount, a precursor to modern bank drafts. Loans were common. A farmer might borrow seed grain to plant in the spring, with the promise of repayment after the harvest. Usually with interest, rates varied, but a 25–30% interest rate on grain wasn't unusual. These loans were enforced by scribes and local officials, and default could result in the forfeiture of land, livestock, or even labor. Unlike Babylon, however, private lending in Egypt was more restricted. The state played a dominant role in organizing economic exchange. High officials, priests, and royal administrators were the main actors in large-scale financial activity. Yet there are surviving records of private individuals, especially women, acting as lenders and creditors in local communities. These cases were less common, but they demonstrate a level of grassroots financial agency not often acknowledged. Coinage was introduced only during the late period, influenced by foreign powers like the Persians and later the Greeks. But even then, Egyptians preferred grain and barter systems over metal money. Proof that a functioning economy doesn't need coins, just trust, storage, and records. So while Egypt lacked the sleek columns of a Roman bank or the aggressive contracts of Babylon, it ran a tight temple-based economy built on grain, writing, and bureaucracy, and laid the groundwork for financial infrastructure that lasted thousands of years. With the rise of city-states like Athens and Corinth in the 5th century BCE, ancient Greece introduced two financial revolutions: the minted coin and the money changer. Unlike Mesopotamia or Egypt, where grain and silver were the dominant currencies, the Greeks embraced metal coinage as a public standard, stamped, regulated, and guaranteed by the state. This shift created a new class of financial professionals, the trapezitai, named after the trapeza, or table, from which they worked in the bustling agora. These men functioned as money changers, deposit takers, lenders, and sometimes outright financiers. They exchanged foreign coins, held money for safekeeping, offered loans, and even kept accounts for their clients. A rudimentary form of checking. Need to send money to another city-state? No problem. The trapezites could issue a written draft, allowing merchants to avoid traveling with heavy, theft-prone coinage. If that sounds like a bank transfer, that's because it was, albeit with more sand and fewer algorithms. Lending was a huge part of Greek banking. Interest rates were generally high, especially for risky ventures like maritime trade. Some loans carried 100% interest, justified by the danger of shipwreck. Piracy, or storm. These were backed by maritime contracts, which included details of the cargo, route, repayment, and collateral. If the ship sank, the loan was voided. If it returned, big profits. Private citizens could also act as lenders. Wealthy Athenians often invested in smaller loans secured by property or slaves. These transactions were documented before witnesses and scribes and could be enforced in court. In fact, Greek courts were flooded with debt cases, an early sign that money, trust, and lawsuits are eternal bedfellows. And yet banks in Greece weren't formal institutions like we'd expect today. They were more like financial freelancers with serious reputations. There were no licenses, no regulation, and no government insurance. If your trapezites skipped town with your deposit, too bad. Trust was everything, and it could be shattered in a heartbeat. Despite these risks, the Greek financial world thrived. It enabled trade, supported empire building, and even bankrolled wars. In a city where logic and debate ruled, so too did contracts, ledgers, and interest rates. Ancient Greece taught us that once you stamp a coin and assign it value, the rest follows. From debt and profit to risk and ruin. By the time Rome ruled the Mediterranean, banking had evolved from small-scale loans to a full-blown financial engine that powered an empire. The Romans, ever the pragmatists, didn't invent banking, but they perfected it, expanded it, and embedded it deep into the fabric of everyday life. At the heart of Roman finance were the argentarii, the Roman equivalent of bankers. These men operated out of tabernae shops near the Forum and acted as money changers, deposit takers, lenders, and agents. They exchanged coins from across the empire, held private deposits for safekeeping, paid out loans, and even executed payments between third parties. Wealthy Romans, including senators, deposited large sums with these bankers, who kept ledgers called rationes, the ancestors of our modern account books. A client could authorize a banker to pay another person using their deposit, creating an early version of the check. Want to send money to Carthage or Alexandria? No need to pack a bag of coins. Your banker could issue a letter of credit. The real fuel behind Roman banking, however, was credit. Loans weren't just for emergencies, they were used for trade, land purchases, construction projects, even election campaigns. Lending at interest, usually around 12%, though it could be higher or lower depending on risk, was legal, though subject to regulation. Usually the charging of excessively high interest was frowned upon but often ignored. Collateral was key. Land, slaves, or future earnings could all secure a loan, and Rome had robust legal enforcement. If you didn't pay your debts, you could be dragged to court, have your property seized, or in extreme cases be enslaved. Unlike earlier societies, Rome allowed corporations of financiers known as societates, publicanorum, publicani, to handle large-scale government contracts, including tax collection. These were profit-seeking enterprises with investors, managers, and shareholders, making them eerily similar to modern banks and hedge funds. Yet there were risks. Roman bankers weren't state-backed, and financial crises did happen. Records show that some banking houses collapsed, triggering waves of panic. Sound familiar? In the Roman world, money flowed through temples, forums, and estates, binding together farmers, traders, soldiers, and senators. And as the empire grew fat on conquest, its financial systems stretched like invisible roads, connecting people not with stone, but with credit, debt, and interest. Before the concept of a central bank existed, the idea of state control over currency was already revolutionizing how economies functioned. In ancient times, the power to mint coins wasn't just economic. It was political. Whoever issued the coin held the trust of the people, and that trust became the backbone of early banking systems. The earliest coins appeared in Lydia, modern-day Turkey, around 600 BCE, made of electrum, a natural alloy of gold and silver. These stamped pieces marked a shift from weighed metal to standardized currency. No more measuring silver chunks in a dusty market. Now, value could be verified at a glance. Other civilizations quickly adopted the idea. The Greeks minted drachmas, the Persians issued darics, and the Romans built an entire empire on denarii. These coins bore state symbols, images of gods or rulers, and inscriptions, not just to represent value, but to signal legitimacy and control. A coin was as much a piece of propaganda as it was a financial tool. With state-backed coinage came new financial behaviors. Hordes of coins were stored in temples, households, and merchant treasuries. Lending became easier and more portable. Coins could circulate quickly across city-states, and with uniform weights and metal content, traders could move goods across borders with confidence. In turn, early bankers, from Mesopotamian lenders to Roman argentarii, adapted to this new certainty. They no longer needed to test weights or purity as frequently. Instead, they tracked coins by type, year, and issuer. This consistency reduced transaction friction, expanded trade routes, and made loans more predictable. Coinage also played a role in inflation and monetary policy, albeit in crude forms. Rulers could debase coins by mixing cheaper metals into the mix, stretching the treasury, but undermining trust. Roman emperors famously did this to pay their armies, triggering cycles of devaluation and economic instability. Still, the idea stuck. Currency backed by a state, stamped with its symbol, and guaranteed in value. This concept laid the groundwork for everything from medieval gold coins to modern fiat money. In a way, each ancient coin was more than just a piece of metal. It was a promise, a contract, and a tool of empire. It told you not only how much something was worth, but who had the power to decide. In the ancient world, the line between faith and finance was often thin, if it existed at all. Temples didn't just serve the gods, they also served as the earliest safe deposit boxes, banks, and loan offices. Why? Because people trusted the gods far more than they trusted kings, merchants, or wandering moneylenders. Take Delphi. For instance, the sanctuary of Apollo wasn't just a religious destination, it was a financial powerhouse. City-states stored war funds there. Wealthy individuals deposited fortunes, and treasuries were built within temple precincts. Religious centers like Delos, Ephesus, and Jerusalem also acted as de facto banks, offering security, prestige, and scribes who kept careful records. A vault under divine watch was seen as safer than any home or fortress. These temples played several financial roles. They held deposits, issued loans, and in some cases even collected interest. In Mesopotamia, as early as the 3rd millennium BCE, temple priests oversaw lending systems where borrowers repaid with grain or silver. In Egypt, temple granaries stored wealth, issued receipts, and facilitated trade. In Greece and Rome, temples frequently held public funds, safeguarded spoils of war, and underwrote construction and festivals, all under the sacred seal of a deity. And temples weren't just passive vaults. They actively lent money. In Athens, for example, the Temple of Athena on the Acropolis loaned silver to the state at interest to fund major public works. Gods, apparently, were patient creditors. Religion also provided the ethical framework for finance. Ancient Hebrew law, for instance, prohibited charging interest to fellow Israelites, but allowed it for foreigners, a moral boundary that blended spiritual identity with economic policy. Hindu Dharma texts laid out rules for fair lending, debt repayment, and even the spiritual consequences of financial misconduct. Of course, these systems weren't without flaws. Temples could be looted in wartime, clerics could be corrupt, but for most of the ancient world, temples were the most trusted institutions, enduring, stable, and reinforced by divine fear. So when you picture ancient banking, don't just imagine dusty coins and cloaked lenders. Picture golden statues, incense, and marble columns, because for thousands of years, the safest place to put your money wasn't under a mattress. It was beneath the watchful eyes of the gods. Long before the invention of credit cards or mortgage calculators, ancient economies ran on a system that was surprisingly familiar. Borrow now, pay later, with interest. Whether you were a Mesopotamian farmer, a Greek merchant, or a Roman senator, if you needed capital, you went to a lender. But the ancient rules of lending were often harsher, and the consequences of default far more personal. Interest wasn't just allowed, it was expected. In Babylon, rates were steep, 20% for grain, 33% for silver, often compounded annually. These figures weren't considered predatory. They were standard. High risk meant high reward, and borrowers understood that if the harvest failed or a caravan didn't return, they were still on the hook. Temples and private lenders alike made fortunes off these loans, and unpaid debt could lead to debt slavery or seizure of property. In ancient Greece, especially Athens, interest rates varied depending on the risk involved. The riskiest loans, maritime loans. A lender might front silver to fund a trading voyage, knowing the ship might sink or be seized by pirates. To offset the risk, rates could soar to 100% or more, but if the ship returned safely, both merchant and lender could make a killing. The Romans added legal muscle to these arrangements. Loan contracts were written, witnessed, and sealed. Collateral land, goods, slaves was recorded in detail. Miss a payment, your creditor could take you to court, seize your property, or in rare cases, force you into bonded labor. Roman law set a 12% interest cap, but loopholes and exemptions made that number flexible, especially during times of economic stress. Despite the risk, borrowing was common. Farmers borrowed seed, merchants borrowed to buy goods, politicians borrowed to fund their campaigns. Lending greased the gears of ancient economies, and default was an accepted hazard. And yes, fraud and manipulation were part of the game. Lenders sometimes demanded bribes or added administrative fees. Borrowers could lie about collateral or disappear entirely. Without credit scores or banking regulations, trust and reputation were everything. In the end, ancient loans weren't just financial tools, they were power plays. To borrow was to risk more than money. It was to stake your land, your freedom, sometimes even your family, on the chance that tomorrow would be better, or at least profitable. From grain receipts in Mesopotamia to the silver ledgers of Rome, ancient banking wasn't just a footnote in economic history. It was the foundation. These early systems of deposits, loans, interest, and financial record-keeping didn't just fuel local trade. They quietly shaped the architecture of global finance. At the heart of every ancient banking system was the same challenge we face today: trust. Could people trust that the weight of silver was fair, that the grain in the temple granary wouldn't spoil or vanish, that the lender wouldn't disappear with their deposit? And out of that trust, or the desperate need for it, rose record-keeping, contracts, and ultimately institutional finance. The innovations were astonishing for their time. Ancient Babylonians developed loan contracts with fixed interest, repayment terms, and legal witnesses, all inscribed in cuneiform. Ancient Greeks pioneered letters of credit, allowing funds to be transferred between city-states without carrying coins. The Romans created bankers' associations and formalized debt enforcement in civil law, building a financial system that could stretch from Britain to Syria. Even today, echoes of ancient banking remain. The modern check evolved from Mesopotamian clay receipts. The concept of collateralized loans is rooted in Babylonian and Roman practices. Central banking and monetary policy trace their ancestry back to rulers who manipulated coin purity or temple wealth to fund armies and public projects. And what about regulation? Well, it turns out ancient societies understood financial crises all too well. In Babylon, kings periodically declared debt forgiveness to prevent social collapse. Roman emperors sometimes imposed interest caps to curb predatory lending. These weren't just economic decisions, they were political acts aimed at keeping society balanced and stable. But perhaps the greatest legacy of ancient banking is the realization that finance is not new. The tools have changed. Clay tablets became spreadsheets. Silver shekels became digital currencies. But the fundamental human behaviors remain: risk, ambition, trust, fear, and the hope of gain. The next time you log into your bank app or swipe a credit card, remember, you're not doing anything new. You're participating in a system that began with scribes in temples, coins stamped by kings, and farmers betting their harvest on a better season. And it all began with a simple idea. Sometimes, to build the future, you have to borrow from it. It's truly mind-boggling to think that concepts we consider modern, like checks, interest, and even financial crises, have roots thousands of years old. What aspect of ancient banking surprised you the most? Was it the temple banks, the high interest rates, or the fact that they had systems for letters of credit? Let me know in the comments below. Thank you for joining me on this fascinating journey into the world of ancient finance. If you found this exploration enlightening, please hit that like button. And if you haven't already, make sure to subscribe and turn on those notifications so you don't miss our next dive into the unexpected corners of history. Until then, manage your assets wisely and stay curious.